Bond yields spiked at dawn. Greece admitted a 12% deficit. Within hours, a currency built on permanence looked conditional. On October 20, 2009, revised figures reached Brussels. The Greek budget deficit was not 6% of GDP, as previously reported. It was more than double that. By early 2010, 10-year Greek bond yields moved past 7%. The spread over German bonds widened by hundreds of basis points in weeks. Traders in London and Frankfurt marked down positions that had been treated as near riskless. The euro had been designed to eliminate currency crises inside Europe. It now faced a sovereign one. The first reaction was procedural. The European Commission requested clarification. The European Central Bank monitored liquidity. National governments issued statements affirming commitment. Bond markets did not wait. In the next 18 hours after one February trading session, Greek yields jumped another 40 basis points. Funding costs rose faster than policy meetings could be scheduled. At the trading desk of a mid-sized German bank in Dusseldorf, risk limits were cut before noon. Greek paper was no longer interchangeable with German debt. Collateral schedules changed. Repo haircuts widened. What had been a unified market began to segment. The architecture that made this possible had been constructed a decade earlier. At midnight on January 1, 1999, 11 exchange rates were fixed irrevocably. Germany, France, Italy, Spain, the Netherlands, Belgium, Luxembourg, Austria, Finland, Ireland, and Portugal surrendered monetary sovereignty to a new institution in Frankfurt, the European Central Bank. The euro existed electronically. Banknotes would follow in 2002. The promise was numerical: budget deficits below 3% of GDP, public debt near or under 60%, inflation converging, bond yields narrowing. The Maastricht Treaty of 1992 codified these thresholds. They were measurable and enforceable. Culture and productivity were not. What mattered was that interest rates would no longer diverge sharply. Exchange rate risk inside the bloc would disappear. Capital would move without friction. Convergence, already visible in the 1990s, would deepen. By 1998, Italian 10-year bond yields had fallen dramatically toward German levels. Investors assumed that once currencies were locked, default risk would decline structurally. In 2001, Greece joined the euro. Its bonds traded only modestly above bunds. The spread would later compress below 30 basis points. On screens in Paris and Amsterdam, the difference looked negligible. The first microfractures were subtle. Germany entered the euro with weak growth and unemployment above 8%. Spain and Ireland expanded rapidly. The European Central Bank set one policy rate for all. For Germany, it was accommodative. For Spain, it was exceptionally loose. Mortgage credit expanded quickly in Madrid and along the Irish coast. Construction cranes multiplied across Valencia and Dublin. The single interest rate felt stable. The effects were not uniform. Between 2000 and 2007, German unit labor costs rose slowly. In Spain and Greece, they climbed faster. Current account surpluses accumulated in Germany and the Netherlands. Deficits widened in the south. Capital flowed from surplus to deficit countries, financing consumption and real estate. Because exchange rates could not adjust, relative prices shifted through wages and borrowing. Bond spreads remained compressed. That was the signal markets watched. By 2007, the euro traded above 1.5 against the dollar. More than 300 million people used the currency daily. The European Central Bank's mandate was narrow: price stability. Inflation remained contained. On the surface, the project looked complete. Then external pressure arrived. In September 2008, Lehman Brothers failed in New York. Interbank lending froze globally. European banks relied heavily on wholesale funding. Governments guaranteed deposits. Fiscal deficits widened rapidly as recession spread. The euro's single monetary policy remained intact, but fiscal positions began to diverge sharply. When Greece revised its deficit in October 2009 to over 12% of GDP, markets recalibrated instantly. What had been treated as homogeneous sovereign debt was reclassified. The assumption of uniform credit dissolved. In April 2010, Greek 10-year yields crossed 8%. By early May, they approached 10%. Athens faced refinancing needs measured in tens of billions of euros. Access to markets narrowed. On May 2, 2010, Eurozone governments and the International Monetary Fund agreed to a 110 billion euros assistance package. The number was large, the signal was larger. For the first time, the euro area acknowledged that a member state could lose market access. The treaties had not described an exit mechanism. They had also not specified a bailout facility. The response was improvised within days. What happened next spread beyond Greece. Irish banks, heavily exposed to property loans, required state support. In November 2010, Ireland accepted an €85 billion rescue package. Portuguese yields rose steadily. In April 2011, Portugal requested €78 billion in assistance. Each intervention was framed as specific. Each widened scrutiny to the next country. Bond traders in Milan watched Italian yields approach 6% in mid-2012. That level was not catastrophic, but it was persistent. The euro had been built on the idea that internal exchange rates were fixed. Now, sovereign borrowing costs were moving as if currency risk had returned in another form. At several points, liquidity disappeared in hours. Clearinghouses adjusted margin requirements. A single percentage point move could trigger collateral calls measured in billions. The initial losses were significant. The secondary effects were larger. The European Central Bank intervened cautiously at first. Under the Securities Markets Program, it purchased government bonds in secondary markets beginning in May 2010. The purchases were limited. Yields remained volatile. Political leaders debated fiscal rules while markets repriced daily. In July 2012, at an investment conference in London, ECB President Mario Draghi delivered a brief line. The bank was ready to do whatever it takes to preserve the euro. The statement lasted seconds. Within days, Spanish and Italian yields began to fall. In September, the ECB announced outright monetary transactions, a framework allowing potentially unlimited bond purchases conditional on reform programs. No bonds were ultimately bought under that program. The commitment altered expectations. Behind the policy announcements were individuals adjusting in real time. Greek pension funds marked down domestic bond holdings. Spanish construction firms halted projects mid-build. In Dublin, homeowners who had purchased at peak prices faced negative equity as property values fell by more than 40% from 2007 highs. Unemployment in Greece would exceed 25% by 2013. These were not abstract adjustments. They were balance sheets contracting simultaneously. Euro itself did not fragment. No member state exited. Greece held a referendum in 2015 rejecting certain bailout terms, yet remained within the currency after subsequent negotiations. The European Stability Mechanism was established with lending capacity up to €500 billion. Banking supervision was centralized under the Single Supervisory Mechanism in 2014. Institutions were added that had not existed in 1999. The underlying structure remained recognizable. Monetary policy was centralized in Frankfurt. Fiscal policy stayed national. Capital moved freely across borders. Labor mobility increased modestly but remained constrained by language and regulation. The single interest rate continued to apply to economies with different productivity trends. The crisis compressed years of adjustment into months. Between 2010 and 2012, Greek GDP contracted by more than 20% cumulatively. Irish GDP fell sharply before rebounding. Spanish unemployment surpassed 26% in 2013. German borrowing costs, by contrast, fell to historic lows as investors sought safety. The same currency transmitted divergent outcomes. Later narratives simplified the period into categories: disciplined north, indebted south. The structural issue was less personal. The euro had been designed on the premise that convergence would deepen once exchange rates were removed. For a decade, financial markets priced that convergence as complete. When fiscal data contradicted that belief, adjustment occurred through bond yields rather than devaluation. The currency survived the test that began in 2009. Bond spreads narrowed after 2012, though they never returned fully to pre-crisis compression. The European Central Bank expanded its balance sheet beyond €4 trillion through asset purchases in subsequent years. Additional countries, Slovakia, Slovenia, Estonia, Latvia, Lithuania, Croatia, adopted the euro under the same convergence criteria established in the 1990s. The framework endured with modifications. The night exchange rates were fixed in 1999 did not feel dramatic. The morning Greek yields crossed 10% did. Both moments belonged to the same system. One eliminated visible currency volatility. The other revealed that credit risk could reappear inside a fixed monetary union. The immediate crisis subsided. Greece regained partial market access. Ireland and Portugal exited assistance programs. Spain stabilized its banks. The euro remained a global reserve currency and the second most traded after the dollar. More than 340 million people continued to use it daily. The system adjusted, as systems often do. What persisted was a structural arrangement in which monetary authority is shared, while fiscal capacity remains divided. The euro removed one adjustment mechanism and relied on rules and markets to discipline the rest. When markets mispriced risk, correction was abrupt. The bond yields eventually stabilized. The bailouts concluded. The currency did not dissolve. The broader question remained how a union built on fixed exchange rates manages divergence when political accountability and budgetary control stop at national borders.